So, good day everyone. My name is Jamaica Anjibatan and this is the continuation of our report 12.5 measuring standalone risk. The standalone risk of a project shows the uncertainty around its cash flow. So, in table 12.1, it shows that the required investment, unit sales, sales price, and running cost for project S, which are all subject na mababago. Next slide is, so the first year sales target was 2,685 units at a $2 per unit pricing. So unit sales, on the other hand, would almost surely be higher or lower than 2,685, and the price would almost certainly range from the expected $2 per unit. Similarly, the values of all the variables would almost certainly deviate from their stated values. So, lahat ng inputs are expected values and actual values may differ from those expected. So, here's the three techniques are used to assess standalone risk. First is sensitivity analysis. Second is scenario analysis. And third is Monte Carlo simulation. Sensitivity analysis. We intuitively understand the changing a major input variable like unit sold or sales price will change the NPV. Sensitivity analysis calculates the percentage change in NPV that occurs as a result of a given percentage change in an input, with all other variables held constant. This is the most prevalent sort of risk analysis, and it is utilized by almost all businesses. So, nag-start ito with a base case scenario in which the NPV of the project is calculated using the base case value for each input variable. So, as we can see, here is a list of the key inputs for project S, which is the equipment, the change in net operating working capital, the unit sales, the sales price, the variable cost per unit, the fixed operating cost, the tax rate, and the WACC. So, ayan. When a senior management examine a capital budgeting studies, they are particularly interested in the way starting with the base case NPV. Pero when they ask the financial analysis a series of what if questions, for example, what if unit sales are 25% lower than expected? Or what if market force us to price the product at $1.80 rather than $2? What if variable costs turn out to be higher than expected? What if variable costs are higher than expected? Sensitivity analysis is intended to provide answers to these questions. But each variable is tumataas or bumababa from its expected value, while other variables is hindi nagbabago, like remain lang yung constant at their base case levels nila. Then the NPV is calculated using the change input. So finally, the resulting set of NPV is plotted to demonstrate how sensitivity NPV is to changes in each variable. Figure 12.1, it shows that as unit sales and price rise, so does the project's NPV, whereas the opposite is true for those remaining four input variables. So an increase in variable cost, fixed cost, and equipment cost, and WACC reduce the NPV of the project. So the range are shown at the bottom of the tables, as well as the slopes of the line in the graph show how sensitive is yung NPV to change in each input. The slopes of the lines in the graph in figure 12.2 indicate how sensitive the NPV is to each input. So the larger the range, the steeper the variable slope, and the more sensitive the NPV is to change in these variables. So we can see that the NPV is very sensitive to change in price, fairly sensitivity to change in variable cost, slightly sensitive to units sold and fixed cost, but not very sensitive to change in equipment cost or WACC. So if we compare the two projects, the one with the steeper sensitive lines would be riskier all or else being equal, because relatively small changes in the input variables would result changes in the NPV. So as a result, sensitivity analysis provide useful insight into the risk of a project. So next slide. 12.5b scenario. It is scenario analysis. Scenario analysis. In sensitivity analysis, we change one variable at a time. It is useful na malaman kung anong nangyari if all the inputs turned out to be better or worse than expected. Also, we can assign probabilities to the good, bad, and most likely base case scenarios. We begin a scenario analysis with the base case scenario, which employs the most probable set of input values. When we then consult the marketing or engineering and other departments, operating managers should define a worst case scenario, which is the low unit sales, low sales price, and high variable cost, and so on. As well as in a best case scenario, the best and worst case are frequently defined as a 25% chance of those conditions occurring. So good or bad with a 50% chance for the worst case scenario. Obviously, conditions can have more than 3 values, but a scenario setup like this can help you understand kung gaano nga ba ka-risky ang project. So, here in figure 12.2, ayun, kung si project is highly successful, the combination of a high sales price, low production cost, and high unit sales, in a very high, the NPV is, as we can see in here, it is $7,450.38. So if the things turned out badly, the NPV will be negative to $4,784.40. So the graph demonstrates the broad range of possibilities, implying this is a risky project. So kapag worst case scenarios, it occurs, the company will not go bankrupt. This is just one project for a larger corporation. So even so, a loss of $4,782.40, it would be detrimental to the company's stock price. So if we multiply the probability for each scenario by the NPV under the scenario, and then add the result, we will get the project's expected NPV of $700.40. So as shown in figure 12.2, it is worth nothing that the expected NPV differs from the base case NPV. This is not a mathematical error. They are not equal. We also compute the expected NPV standard deviation, which is the $4,370.24. We calculate the coefficient of variation 6.19 by dividing the standards deviation and by the expected NPV. This is a measure of standalone risk. So the CV of 6.19 indicates that this project is much more risky than the firm's average risk project, which has a coefficient of variation of about 2.0 riskier than the majority of the company's other projects. So our firms, which is the WACC, is 10%, so that the rate should be used to find the NPV of an average risk project. There is no way para ma-determine the correct discount rate, but some firms increase the corporation WACC when they evaluate projects deemed relatively risky. So when the NPV was recalculated using a 12.5%, the WACC, the base case NPV fell from $78.82 to $33.62. So the project still had a positive NPV when its expected cash flow were discounted at the risk-adjusted WACC. So our firm WACC is 10%, so that the rate should be used to find the NPV of an average risk project. Project S is riskier than average, so a higher discount rate should be used to find its NPV. But there is no way to determine the correct discount rate at this judgment call. So, ayan. Next is Monte Carlo simulation. So, Monte Carlo simulation project are analyzed under a large number of scenarios or runs. A computer randomly picks a value for each variable and it turns into a NPV. The mean of 1000 NPV is used as a measure of the project's expected profitability. Technically, Monte Carlo simulation is more difficult than scenarios analysis, but however, simulation software makes the process more manageable. Simulation is beneficial, but because of its complexities and detailed discussions, so it should be reserved for advanced finance students courses. Next slide. So within a firm and beta risk, sensitivity analysis, scenario analysis, and Monte Carlo simulation dealt with standalone risk. So sa isang theory, we should be more concerned with within firm and beta risk. So managers can make judgmental estimates about whether a project returns will be high when the economy is strong. Our conclusion regarding risk analysis are as follows. So it is very difficult, if it's not impossible, to quantitatively measure projects within a firm and beta risk. Next, most projects returns are positively correlated with the returns on the firm's other asset and with the returns on the stock market. This being the case because standalone risk is correlated with within firm and market risk. Not much is lost by focusing just on standalone risk. So, next is experienced managers make many judgmental assessment, including dito yung those related risks, um, and they work them into a capital budgeting process. Introductory students like need precise answers, and they want to make decisions on the basis of calculated NPVs. Experienced manager consider quantitative NPVs, but they also bring subjective judgment sa isang decision process. So, if a firm that does not use the type of analysis covered in this book, it will have trouble. On the other hand, if a firm tries to quantify everything and let a computer makes its decision, it is too will have trouble. Good managers understand and use the theory of finance, but they apply it with judgment. So, ayun. So, what do you get if you choose between a conveyor belt and a fleet of forklift trucks? So, choosing one means rejecting the other one. Also, the equipment used in the distribution center will be used for many years, so it will be replaced when it wears out. So 12.7 Unequal Project Lives Part 1. So, and if a company is choosing between two projects, wait. So part 1 of figure 12.3 shows the analysis that traditionally would be used to analyze itong two projects. So if we see if a company is choosing between two projects and those projects one have a significantly different lives, two are mutually exclusive, and three can be repeated. So the regular NPV method may not indicate the better project. So we see that the project C, wait, we're going to next slide. Yan. So we see that project C, when discounted at a 12%, WACC has the higher NPV, and thus it appears to be the better project. However, the traditional analysis is incomplete, and the decision to choose project C is actually incorrect. So if we choose project F, we will have an opportunity to make a similar investment in 3 years. And kapag pinili naman ay if a cost and revenues remain at the part 1 levels, the second investment also will be profitable. Pero kapag pinili naman natin ang project C, we will not have the options to make this second investment. Therefore, to make a proper comparison between C and F, kailangan natin ng adjustment. So, we discussed the two methods for making the adjustment in the remainder of this section. Next slide. So, first, next slide. This involves finding the NPV of a project F over 6 years, which is also the life of project C, and then comparing the extended NPV with the NPV of project C. So over the same 6 years, we see that a common life basis F turns out to be the better project. First, we can apply the replacement chain, which is the common life approach as shown in part 2 of figure 12.3. So as we can see, the project F is better project to build on a common life basis than project C over the same period of time. Next is equivalent annual annuities. So, electrical engineers design power plants and distribution lines were the first to encounter the unequal life problem. Hindi nila magamit yung transfer transformer that had a relatively low initial cost but a short life. So, or they could use transformers that had a higher initial cost pero longer lives. So the NPV of each project over its stated life is determined by finding the cost constant annual cash flow that has NPV provides over the project's initial life. Transformer would be required into the uh, indefinite future. So this was an important consideration para sa mga engineerings. So a method that calculates the annual payments that a project will provide if it is an annuity. So when comparing the projects with unequal lives, the one with the higher equivalent annuity or EAA should be chosen, like the Project F. So next slide, which is the last part, the conclusions about unequal lives. So another question often arises, no, yun. So yeah, another questions often arises, do we have to worry about unequal life analysis for all the projects that have a unequal lives? So as a general rule, the unequal life issue never arises for independent projects. Pero it can be an issue kapag we compare mutually exclusive projects with significantly different lives. However, the issue arises if, ayun nga, and only if the projects will be repeated and in the end of their initial lives. Thus, for all independent projects, those mutual exclusive projects that will not be repeated, there is no need to adjust for unequal lives. So yun nga, the replacement chain and EIE methods always result in the same decision. So it doesn't matter which one is used, and the EIE is a bit easier to implement, especially when the longer project doesn't have exactly twice the life of the shorter one, and those more than the two cycles are needed to find a common life. Ayun. However, the replacement chain method is often easier to explain to senior managers nga. Also, it is easier to make a modifications to the replacement chain data to deal with anticipated productivity improvements and asset price changes. So for those reasons, we generally use the replacement chain method when we work with non-engineers, but when engineers are involved, we show both results. That's all, and thank you for listening.